Hi, I'm Chance Finucane, Chief Investment Officer at Oxbow Advisors. Today we want to walk through the factors we believe will be most important for the equity market in 2023. First, we believe the inflation rate remains too high for the Federal Reserve and other central banks around the world to start cutting rates like investors hope they will. This is a chart that Hedgeye put together that we like, that looks at the basket of goods and services that households think of most often when they think about their expenses. So it's a combination of shelter, food, medical costs, energy, such as gas you put in your cars, and your cell phone bill. Right now, the combination of these expenses is still increasing by nearly 8% versus last year. Way too high for the Fed to start cutting rates and saying, oh, we did what we came here to do. Even if we look at the overall inflation rate, that's 7%. If we look at the core PCE inflation rate that the Fed tracks most closely, that's 4.7% right now, which is still above the federal funds rate. Chairman Powell has said he wants that Fed funds rate to be above the core PCE. All of this suggests that they're going to keep rates high for longer than people might want. And that's going to make it a tough environment for equity investors to do well. But what happens even when the Fed eventually does pause its rate hikes or starts cutting rates? There's a narrative right now in the investment community that that's all we need and then stocks will start going up again. But if you look at history, we've had 16 rate hike cycles going back to 1929. And in half of those cases, the stock market fell by at least 20% or more after the last rate hike. So a pause doesn't necessarily mean that everything's good again for stocks. And if we look at the last two multi-year bear markets, the dot-com bubble and the great financial crisis, the two periods that we consider to be most similar to what we're experiencing today, in both those cases, the Fed started cutting rates and would cut rates by a double-digit number of times, and yet it still was not enough to stop the bear market from continuing and fully running its course. So while we're mindful that a pivot to cutting rates will start bringing some easing into monetary policy, that is not a signal for us that, oh, we need to start buying stocks. There are a lot more factors you need to judge along with that decision by the Fed whenever it happens. We do expect a recession in 2023. We have a lot of indicators showing that we think anytime, either now or in the next 3 to 6 months, you could be starting a recession in the U.S. This is one indicator that we think is pretty simple that has been effective going back over 40 years. So it looks at the amount of activity by state in the U.S. Is activity increasing or decreasing in each state? And when you see a shift where there are more states reporting decreasing activity rather than increasing, in every single case going back to 1980, you were on the verge of entering a recession. And that's where we're at right now. If we are heading into a recession, that means we're going to have a profits recession for company earnings as well. But this isn't in the estimates of analysts on the street. They're still anticipating that earnings will keep growing next year and in 2024. But earnings for the S&P 500 tend to follow a pretty similar or pretty clear trend line going back multiple decades. Right now, we're well above that trend line, and the amount of headwinds that we're seeing to company margins and just economic growth slowing, it would not surprise us in the least if we see earnings fall in 2023 back towards that trend line or even fall through the trend line to where you're below the long-term average growth rate. This is another way to look at this trend line growth for earnings for the S&P 500. We like looking at it this way as well because it shows that when earnings are above trend like they are currently, when the reversal begins and you start seeing earnings start coming back down towards the typical trend, it doesn't stop at the average. You tend to run through the average to where you're actually under earning versus the trend rate. And even in what were considered smaller recessions like 1990 and 2001, the same effect occurred. So if you're going to see earnings per share roll over and start being negative, we would expect that to be by more than people anticipate, and that would be a key driver for what sends the S&P 500 lower to start 2023. Because of this outlook for the economy and for company profits, we remain defensively positioned. We always want to make sure that we're protecting our clients' assets as best we can in a bear market or an adverse environment for risk assets. However, we know from studying all the past starts of new bull markets that first year off of a great market low tends to lead to huge returns. There have been 5 great buying opportunities in the last 15 years, either off of a correction or a bear market. And if you just look at the performance of the S&P 500 in the first year off of each of those lows, the average total return is 51%. And we want to make sure that we're participating with that whenever the time comes. So we're going to be tracking this closely to make sure the valuations are right and that we don't miss this when things do turn. But we still need to see more deterioration in company earnings and in the overall economy before we start to think that an opportunity like this is going to develop. We hope that gives you an idea of how we're seeing the equity market heading into 2023. And if you have any questions, please contact us.